Good morning, everyone. My name is Hugh Van Steenis. I'm delighted to debate how the city can make a success of Brexit and contribute to the policy debate today with Douglas and Jess. Two short thanks. First to Jonathan Paul for organising this conference. I think it's a very important topic, but also I think the three of us personally felt very keen to support Jonathan and Paul's initiative. And then secondly, to David Davis and his team here today. I think the three of us have found the level of engagement with government very encouraging, and certainly across DexEU, the Treasury and the Prime Minister's Office, we personally and our teams have done a significant number of meetings to try and roll up our sleeves. So with that, really I'd like to introduce to my far left Jess Staley, who's the Group CEO of Barclays since 2015 after a very long and distinguished career at JP Morgan. And Douglas Flint, Chairman of HSBC, again after a very distinguished career at HSBC. The way I thought I'd really...
Good job, Douglas.
Exactly. So with this, I thought the best way to start is a quite broad question. Really, think about what's your overall philosophy on how the city should work with the UK and European governments to make a success of Brexit. Maybe, Jess, if I could start with you first.
For sure, we start this whole discussion with the fact that the City of London and the United Kingdom, but London really is the financial center for Europe and arguably one of the two financial centers for the world. Some 83% of all capital markets funding for continental Europe flows through London. And finance really is the oxygen of commerce. And so having the free flow of that oxygen is critical to the growth of Europe and obviously critical to the growth of the United Kingdom. And so protecting the role that London has today, I think, is a benefit for Europe overall. The financial industry and the capital markets in particular is really measured not by physical capital, but it's measured by intellectual capital. And what London has is it has a concentration of intellectual capital around the financial markets, which is truly unique. So what we need to do, I think, as a major bank and a bank that actually is the largest underwriter of European sovereign debt, is to make sure that we work collaboratively with the UK, work constructively with the governments across the European Union, so that we articulate the value of the intellectual capital resident in London and how we can manage the financial industry for the benefit of commerce across all of Europe. There's going to be a great deal of uncertainty that we're all going to have to live with for the next couple of years. I don't think anyone is under the illusion that this is going to be done quickly. And as we deal with that uncertainty, having a level of discourse and dialogue, particularly here in the United Kingdom, but also across all of Europe, is an obligation of Barclays. To be a constructive partnership in that dialogue is good for all of us. But ultimately, at the end, what we need to work towards is the United Kingdom playing a critical part in providing financing across all of Europe, and to be a partner with Europe for the benefit of the entire region. And so we are committed and delegated and already are engaged in very deep discussions across with the UK government, sharing our views, our thoughts. We are seconding some of our most talented people to parts of the British government in order that they have the manpower to deal with the complexity of the issues that they face. But I think at the end of the day, we're encouraged that we can get to an endpoint that will continue with London as a financial center for Europe.
Thanks. Douglas.
I think one of the things the Secretary of State said was very important, which is that it's essential that this is a deal that works both for Britain and the EU 27, i.e. we want them to be successful and we should want them to want us to be successful. And I think that plays into something that we've said to government, which is we should look at this through the prism of our customers. When we talk to our customers, they have many, many issues in relation to their own businesses, but in relation to the provision of financial services, they're relatively relaxed because they simply say, you fix it. whatever we want to do, wherever we need to do it, however it's going to be structured, we expect our banks and the rest of the financial system to be able to give us what we get today at the same kind of price, and you work out the logistics and the mechanics and the pipes and all the other stuff. So they regard that as our responsibility, and in a sense we're an industry that is used to change, usually through regulation. So I think that the most important thing, if I were setting a framework for both sides of the argument, is we should aspire to a situation, the access to finance in terms of quantity and pricing, availability of hedging products, the ability to manage money, liquidity of markets is maintained. I'm sure there'll be debates about where activities take place and so on and so forth, and legal jurisdiction and so on. But we should aspire that the quantity of finance available to the economies of Europe is not interrupted, and that the services that are available around those credit facilities remain intact in aggregate. Then I think, where again we should be able to find agreement is, Secretary of State made a very important point about being clear as soon as we can about the respective rights of EU citizens in the UK and vice versa. I think there's the second thing that I think we look for at the earliest possible moment is clarity on that there will be an implementation phase and the likely duration of that phase. Secondly, I think we need as early line of sight to where we're trying to get to, and it would be better to get a good deal in a reasonably short period of time rather than a really excellent deal so far into the future that people will have triggered all their contingency plans because they don't have any alternative. So that's kind of the framework I would put, and that's what we'll be working towards.
So Douglas, so maybe I'll just pick up on that last point you made about an implementation phase. So obviously the Secretary of State talked about avoiding a cliff edge, but I'm struck across the city how many firms are saying if we don't have a transitional agreement in place between, say, Easter and summer of next year, quite frankly, the contingencies will have to kick in because individuals, families need to think about their education and their schooling, they need to think about the responsibility to staff. So how important is a transition arrangement for you? And at what point, are you working on a planning assumption it's coming too late? Or when is too late? That would be...
Well, I think everyone has to plan, and indeed our regulators are demanding to see, quite rightly, demanding to see our plans. You're right, the biggest issue, or one of the big issues, is staff need clarity. We've got 2,000 EU citizens working for us in London, and they have to think of their family circumstances. I think all of us will plan, and certainly from our perspective, delay triggering until we absolutely know that there is not going to be the possibility of retaining certain services in London, if that's the case, or that we simply need to get clarity for our clients as to where things will happen, and in the absence of an implementation phase, we might need to move. In our own particular case, we're now rewriting history to say that we bought a huge bank in France in 2000 in anticipation of Brexit. In actual fact, it was in anticipation of the government at that time talking about joining the euro. It was to get euro clearing. So kind of we revisited the script. But so we have everything we need in Europe and France. But having said that, I think that the point that Jez made, which I think is the most fundamental one, which is the cluster effect of what exists. I think the International Financial Centre that exists today in London is an international asset first, a European asset second, and a UK asset third. I think we shouldn't think of it as a UK asset. It is the most important international financial system globally, and it has global significance. And I think looking at it in that frame of mind, I think, is much more important.
No, I don't. If there is absolute clarity on an implementation period in reasonably short order, that would be terrific. I don't. I think. Personally, I imagine that's going to be tough to actually lock down. If you have to just take a simple exercise, if you have to relicense a branch in Europe. And in that relicensing process, get approval from the local central bank and begin to novate all the contracts from a current branch to another branch. That simple novation process, given the complexity of financial instruments, will take 12 months, 18 months. And if there is any degree of uncertainty in terms of that 2-year cliff, that implementation period has got to start in a reasonably quick period of time. It would be terrific if we had certainty in short order, but I think on one degree the financial industry is going to have to start to execute structural reforms that will give certainty to continue operations beyond a 2-year window and not be completely exposed to an implementation period for whatever reason following. I don't believe that means by any measure wholesale shifts of people or products or services or whatnot, but the contingency plans are going to start to roll forward in a reasonable period of time. And what we are doing at Barclays is, one, being very transparent with our regulators as to what those contingency plans are. We're not going to surprise anybody. We've got robust dialogue with the Bank of England, with central banks across continental Europe. So I think you will start to see movement in a reasonably short period of time. It's not going to create any great disruptions or mass migrations, because I think there's underlying a belief that we'll come up with a settlement that will be least disruptive possible for all parties. But I've got to envision that it's going to be reasonably hard to get certainty around that implementation phase such that people halt. We will need an implementation period in any event. I mean, if you make a 5-year loan to a German corporation next month, at the maturity date of that 5-year loan, what's the overriding legal jurisdiction? So there are lots of issues that, in the granularity, are very difficult, and people need to start to adapt to those possibilities in reasonably short order.
Thank you. So let's just continue on sort of talent. The banking and financial services sector is the biggest contributor to buying technology services. And Jess, I was very struck by a comment you made the other day that you thought that Google investing in the UK was one of the most important announcements post Brexit. Do you want to elaborate on that and how you think we're going to retain great tech talent to support your businesses?
Maybe 2 comments about one, technology, but one before about why I think London has got such a strong position in terms of being a financial center. I was speaking at a conference at Morgan Stanley the other day that had about 500 institutional investors listening to a number of CEOs speak. And so it was people from the buy sides like Capital and Fidelity, Legal and General, Marshall Wise, all of the buy side firms. And so we asked a question to all of them. We said, how many people in the audience are in current discussions with their firms about possibly relocating outside of London? There were 500 institutional investors in that room. Not a single hand went up. And the location of the financial markets is not a function of where the banks are. It's a function where the capital is and where the managers of that capital is. The second thing I would say related to Google is, in many ways, large banks like HSBC and Barclays are essentially technology companies with a balance sheet and regulators. And technology is exploding in its importance to the financial markets. And so my comment was, post-Brexit, for me, perhaps the most important economic announcement made that will impact Barclays in the future was the one made by Google. And when Google, 3 months after the Brexit vote, essentially said that the second largest center for technology application development outside of Palo Alto will be the City of London. And that they hope to put in the middle of London, at the end of all this process, roughly 7,000 engineers to do technology development. If we're technology companies, and this is all about the intellectual capital, that may be the single biggest event that's happened post the Brexit. And if London can secure itself as a technology center, that will be another major anchor to keep the financial industry in London.
I agree. Douglas, do you want to add?
No, I absolutely agree. I mean, I think it's really encouraging the comments that were made by the Secretary of State and other government ministers about as a global Britain, we have to attract the top talent in every industry, and people are coming in, creating innovation, highly paid, contributing to the tax base of the UK. That's hugely important. In fact, we're seeing some of the restrictions on getting visas for foreign workers in the US playing into the UK's current strengths and being a very, very welcoming place. So, one of the great things about being an international financial centre is that the fintech firms and indeed the other firms seeing the number of international companies here, they can get exposure to almost every financial system participant in London because every country in the world is represented here, and I think that's positive as to how you build the cluster.
You could almost argue more important than passporting for the financial industry is the immigration policy. In getting the best and brightest students in the universities in the UK and then funneling that intellectual capital into places like London, that may be, over the longest term, the most critical component of the robustness of Barclays and the financial industry in London.
I certainly agree with that as well for the asset management industry too. So just to I think it's difficult not to have a banking panel with one question on regulation, but I'll try and keep it brief. I think there's two aspects on regulation that we've debated. One is obviously a level playing field, and second is regulatory clarity. At a time when the US is now reappraising the hard edges of the post-crisis reforms, some Brexiteers had hoped for a bonfire of regulations. I personally see very little evidence of that. So maybe two questions. First, are there any regulations you feel would be useful to reappraise? And number two, are you worried about an unlevel playing field as UK, US, and EU 27 rules may diverge in the future? So Douglas, maybe first.
10 years post-crisis, we haven't finished finalising the rule set. I think the sooner we do that and stop, the better, because we need clarity. I would not pull. There are some things we might look at again in terms of reporting obligations at the edges, but all the big stuff on capital, liquidity, and so on, have significantly improved the resilience of the system, and therefore we should retain that. We've invested hugely in doing that. Fragmentation would be a disaster because undoubtedly capital flows to where there is the least cost or the maximum ability to leverage over time. So a fragmented system would destroy almost everything that's been done over the last decade. So that would be a very, very bad step. But no, I think we certainly don't want to be tinkering at the edges. We really need a steady framework. Not only are we dealing with the regulatory challenge of finalising it, we've got the complications of the changes that will arise out of Brexit, and of course in the UK, over the same 2-year period, we are ring-fencing our UK operations.
One of the silver linings, I think, of the financial crisis was the effectiveness of the G20. And one of the things that I would hope as the issues around globalization and free trade are debated in the US, Europe, and the UK, the role of the G20 is sustained. And with respect to the financial industry, I think the G20 recognized that the entire banking industry globally needed to be re-regulated to a massive scale post the financial crisis. But what they also agreed upon, and they've been very consistent in implementing, that as you re-regulate the banks across the globe, no one should use the re-regulation to create barriers to the free flow of capital. And they were very effective at that. So as you launch the Vickers Rule or Dodd-Frank, if you notice, nothing has been done that inhibited the flow of capital across national borders. And that's critical if we're going to have a global economy that functions. And one would hope that whether it's the review of financial regulation in the US or the negotiation between the UK and the European Union around the financial industry, that no one regresses and goes back to building barriers of entry. Right now, I think there is reasonably level playing field across the entire regulatory framework. You do get strong indications that they are going to review the basic architecture of the regulatory framework in the US. We just would hope that as it is done, it stays committed to the proposition of the G20 to try to create a level playing field financially, irrespective of geography.
Okay, thanks. Moving forward, obviously one of the key anchors of the city is its role in funding companies' infrastructure projects, the real economy across Europe. So, first, do you see any risks to the funding of the real economy? And in particular, do you think there's a case the city can make about its role in funding EU27, which could potentially be at risk from Brexit? I don't know, Jess, maybe if you want to start on that.
Well, I'm both HSBC and Barclays Bank, both banks are firmly committed to the economic prosperity of the UK and providing all the credit safely that this country needs for economic growth. And one of the things I would say, there are a lot of concerns about the economy post the Brexit vote. One of the things I think the banks did is post the Brexit vote, HSBC, Barclays, Lloyds, and other banks kept the channels of credit wide open. No bank responded to the Brexit vote by shutting their doors. In fact, to the contrary, I think all of us opened the doors for mortgages, for lending to small businesses, et cetera. And that free flow of credit actually was very important in stabilizing the economy after that sort of political that political shock. Clearly, the banks want to continue to also fund continental Europe. We're also, Barclays is the largest underwriter of non-European companies borrowing in Eurodollars. Think how powerful that is for helping the Eurodollar itself become a global reserve currency and in turn support the monetary policies across the European Union. So not only are we here to provide funding for European companies, we're also here to provide funding in Eurodollars to non-European countries, and there's a value companies, and there's a value in that. But I think the banks have done two things. They have recapitalized themselves in a dramatic way, as Douglas was saying, but also we have kept the channels of capital wide open, and I think that has been critical to the response of the economy post the Brexit vote.
The system's awash with liquidity. There's no shortage of money for those who are eligible borrowers. I think that one of the important discussions that will take place as we reshape our relationship with Europe is the future of the Capital Markets Union project. I mean, it's hugely important to Europe. An overdependence on bank finance, which is one of the biggest distinctions between Europe, continental Europe in particular, and the United States. A huge ambition within Europe to change it, challenging. I mean, there's not really a single market in financial services in Europe. There's not a single deposit protection scheme, for example. So Capital Markets Union was a huge opportunity, and I think you cannot actually imagine that taking place after the UK leaves the European Union without the UK having some role in that because of the scale of the capital markets and the cluster of expertise that exists here. And I hope that a big part of the discussion will be about how does that resource get used to create capital market access and capability to the benefit of the whole of Europe, because it would be a really retrograde step if we don't make the progress that was envisioned while we were part of Europe.
I think that's right.
Yeah,
part of the EU.
Yeah, Jess.
Douglas, I think, makes a very, very good point. The rough numbers are, in the United States, 80% of corporate financing comes from the capital markets, i.e. debt issued and purchased by insurance companies and mutual funds, whatever, and 20% is funded off of bank balance sheets. In continental Europe, it's the flip side. Corporates are funded 80% by bank balance sheets and only 20% by capital markets. Bank balance sheets are inherently more risky than the capital markets. And therefore, this movement to try to make Europe look more like the United States in its overall funding is very important. Another advantage that the UK has got is to have a developing capital markets. What is absolutely critical is a very effective, predictive, well-known bankruptcy court. Yeah. After the 2008 financial crisis, there was $3.5 trillion of defaulted debt in the United States. In 18 months, it was all renegotiated. Right now, the only legal system, I think, around the world that has the bankruptcy clarity, effectiveness, speed, transparency, predictability is the UK. You have to be able to calculate what's called the loss given rate of default in a bond if you're going to have a robust capital markets. And losing the support of the UK legal system would, I think, be a big setback in the effort to try to develop a capital markets in Europe, which is similar in its scope and scale to what you see in the United States.
No, Jess, Doug, I agree with you both, and obviously not just to flatter Jonathan here, but I think on CMU, we'll go. But I mean, 2 points. One is if you look at the eurozone, the markets have provided 600 billion euros more funding to eurozone companies since 2009, and bank-based finance has pretty much shrunk the equivalent 600 billion. So it really is having an impact. The challenge at the moment, though, is new initiatives on CMU seem to have got into the buffers at the moment because given the bigger picture of what's going on, I think that's all something we'd like to see re-accelerate post negotiations. I've got one last question, then I'll open it up to the floor. Obviously, how does the election change your view, if at all, Douglas?
No, it doesn't really change the view. I mean, one hopes that once the election is over, the government has, whichever government it is, has clarity of mandate and more capacity to negotiate than it might have at the moment.
I'm still learning. It seems, I sort of echo the comment that the greater the clarity and the greater the political attitude to negotiate a Brexit, which is best in the United Kingdom, seems to make a lot of sense.
Okay, super. So with that, I'm very happy to open it up to the floor. I assume there are roving mics. Yeah, there are indeed. So, gentleman here first, please. And if you could say your name or affiliation, it'd be very helpful.
Yes, thank you. David Marsh from OMFIF. I wondered if both gentlemen could give us a view about... I wondered if both Douglas and Jez could give us a view about China in your dealings with the Chinese authorities, the Chinese asset managers, the Chinese banks, whether they're giving the thumbs up, the thumbs down, or just don't know about our future in London after we leave the European Union.
Well, the Chinese banks are distinctive against, say, for example, the Japanese who hubbed in London. The Chinese effectively put branches directly into all EU states. So it's a different complexion in terms of financial services. In all the discussions I've had with them, they still believe very much in the service capabilities of the UK. I mean, the UK is now the largest trading hub for RMB outside of China and Hong Kong. So they see huge opportunity. They're much more familiar with what happens here, and I think they continue to want to work very strongly on RMB, on Stock Connect, linking the stock markets through London into Asia, and also the cooperation between the People Bank of China and the Bank of England on green finance, focused on Belt and Road. Again, are huge opportunities for harnessing the capital markets and legal system and project management and public-private partnership structuring expertise that exists here with the ambitions they have across infrastructure from China to the European communities. So, I think they still see a huge amount of opportunity, and I think we're certainly leveraging that, and I think many others in this room are too.
I think we all have to recognize that China has been an enormous beneficiary of the opening of global trade and the free flows of capital. And I think, as President Xi articulated in Switzerland, in many ways, China hopefully is going to take a leading role in supporting free trade and the free flows of capital. And as trade and globalization gets debated politically across the landscape, hopefully they continue to play a very constructive role.
Great. Any other questions? Gentleman in the middle here.
Phil Aldrich at the Times. I just wanted to pick up, Mr. Daly, your comments about immigration being more important than passporting for the post-Brexit relationship with Europe. Is there a template? Is the US migration policy the one that the UK should follow? Do you want to see us more open than we were before? Would you want caps? I mean, do you have any kind of structure?
I don't have a sort of a political agenda. I do think, one of the things, we have 3,000 employees in the UK that have European Union passports. We would love to give, as soon as we can, certainty to those 3,000 employees that their position in the United Kingdom is secured. And we as a bank are going to do everything we can to protect our employees from the European Union that work for us here. As I said, intellectual capital and the concentration of intellectual capital is perhaps the most important asset that London as a financial center has. But clearly bringing in talent into universities and whatnot that have the ability to stay and work in the UK has got to be seen as a treasured asset of the United Kingdom. And if other countries are beginning to limit the free flow of talent and the best and the brightest, obviously we would hope the United Kingdom not follow that trend.
I think that's right. And maybe I'll just add, I mean, on the surveys around of all the banks, between about 15 and 20% of staff are EU nationals. Obviously, some of them would already have right to remain because they've been here for more than 5 years. Actually, a surprising number haven't applied, and many of the banks have actually tried to encourage them to apply.
Yeah.
But I think I'd echo Jess's point that skilled workforces and critical mass does give the city a significant, advantage. But anything to underpin that, particularly around technology, which I think over the next 5 to 10 years is going to be the number one source of jobs from the banks and asset managers, I think is going to be something which will be critical for government policy. Any other questions? Simon, in the front. Sorry.
Thanks, Simon Jack, BBC News. It's more a question about this event, really. We've seen the business voice was largely ignored in the referendum. The global elite, as represented perhaps by Paul, Sir Paul Marshall here, has been sort of not been popular in the political discourse. This is a coalition of the business lobby and the global elite, a coalition of the irrelevant and ignored by political processes. I just wonder whether you think what's going to change about that, because politics is not about people looking for value for money and nickel and diming each other and whatever. The politics are much bigger than that. I just wonder whether you think that this voice and this, events like this can really pierce through that.
Douglas.
Thank you. Oh, Jez was really well placed for that one. You're absolutely right. The referendum exposed a much broader set of issues, and business had a particular voice, but that was a single view, and that broader view exposed a lot of issues. I think we have to make ourselves more relevant. At the end of the day, all the political ambitions that are aspired to need to take place in an economy that can afford them, and that requires the execution of business initiatives, innovation, competitiveness, and so on. And that's what we do, and that's what we continue to do. So the framework's changing. I mean, we are in an industry that's faced massive change in our business model and so on, and our structure because of regulation. This is a further structural change, and we will adapt. And I think business will perhaps regain some credibility and voice if the prosperity that this conference is talking about is seen to be enhanced or protected, or the damage that could happen mitigated by actions taken by business. Politics will create the framework. Business within that framework will hopefully create continuing prosperity, jobs, economic growth, and so on, that gives it a voice again.
I think there's a deep respect for the result of the referendum. And I think the response starts with that deep respect. Secondly, as I said, I do think that the British banks have kept the free flow of capital and liquidity wide open to customers all across the United Kingdom, from north to south, and from small businesses all across the United Kingdom. And that has allowed, I think, or helped the economy do quite well post the Brexit vote. And I also, properly managed, so we don't put the economy at risk. The financial industry is important for the United Kingdom. The banks, I believe, are amongst the largest taxpayers in the country, helping to fund critical social programs across the country. But I think it starts with a deep respect for the vote that was taken and the referendum passed. And this conference, if anything, is trying to maximize for the benefit of the UK how we all respond to that popular vote.
I think, can I say one other thing which I think is often not recognised and maybe taken for granted. On the 23rd of June last year, people went to bed with the commentators, the pundits, the posters, the markets predicting an outcome that the following morning wasn't delivered. So it was much against expectation. The following day, market volumes went up by about a factor of 6. There was massive volatility. Banks that were particularly exposed to Europe saw their stocks move 25–30%. And yet, the liquidity of the marketplace, the strength, everything settled. There was no disruption to the marketplace. In a very uncertain period with an extraordinary amount of volume and volatility, the market worked. And I think that that's an extraordinary credit to the marketplace in the broadest sense, regulators, Bank of England, participants and so on, that we have an international market here that can cope with an extraordinarily unexpected event with huge volumes going through it and nothing, collateral moved, cash moved, institutions could get liquidity when they needed it. I think that's an extraordinary asset for the international financial system that we shouldn't take for granted.
Simon, Jonathan encouraged us to give sort of practical policy suggestions, so maybe if I give one to the two gentlemen who've got the results in the next week or two. I think that global firms need to show they're relevant to the domestic economy. So the first line of their annual statements and quarterly statements should be how many small businesses they funded, how many individuals they helped buy a house, and how many large and how many projects they funded. And if they did more about accentuating their role in society, certainly we'd reduce the toxicity, but I think toxicity will take a very, very long while to go. Peter, got another? I'm sure someone's going to tell us when we're running out of time, so I hope.
There's one over on your right.
Yeah. So there's one here, and then I'll come over to one over there in a moment.
Peter Wilson-Smith from Emeritus Consultants. If you look at the city today, I mean, 70 or 80% of its business is international at the moment. It's hugely successful international centre that's been growing. Do you think Brexit is going to change the way that international side of the city develops? Will the trajectory change, or will it continue to develop much as it would have done had Brexit not happened? I mean, I suppose in a way the question is, will you, running big international institutions, will you be thinking strategically, we need to put a bit more emphasis in future on the international business because it may be a bit more difficult to do certain types of business in Europe?
You know, the core strategy that Barclays laid out in March a year ago was a belief that the safety of a bank is anchored in having a diversified portfolio. And the diversification really comes in two ways. Being diversified between a consumer bank and a wholesale bank, which I think both Barclays and HSBC have, and a diversification geographically. The principal diversification that we have is between Europe, and the UK in particular, and the US. Maintaining that diversification, I think, is healthy for the banking system overall, makes Barclays a safer bank, and so I think the international reach of Barclays as we've presently defined it really really won't change because of Brexit.
I'll just say one thing. So much of the emphasis to make the financial system more resilient post-crisis was about on-exchange trading, central counterparties, bringing as much risk as possible into one place so that you get the maximum offsets for credit control and transparency. Anything that kind of fragments that clustering of risk and offsetting of risk, I think, would be disappointing. And I think that, you know, the UK, partly because of the unique advantage of the time zone, is uniquely placed to bring risk from all over the world into one place, do the offsets and do the management. And that's something I think to the benefit of the global financial system we should seek to preserve.
Thanks. I haven't been kicked off yet, so if there's one more question, the gentleman in the front row. Yeah.
You spoke about UK banks actually having done a lot to repair their balance sheets ahead of the financial crisis. I think that's very, very good. I'm not sure that everybody has equal amounts of confidence about some of the European banks having equally robust balance sheets. And I wonder, just speculating without naming names of your colleagues and competitors in Europe, what you think might happen as a result of Brexit if there were a renewed financial crisis within the Eurozone.
Do you ever hear that question?
I do.
You're going for the short straw again, Douglas, or just...
I mean, just the news this morning that Credit Suisse announced a 4 billion Swiss franc rights offering to take their CET1 capital ratio north of 13%. I think that's a bold move by Credit Suisse. I think that's followed by the capital raise that Deutsche Bank made. That was also extremely successful. That followed the capital raise that was done by UniCredit in Italy. That was also equally successful. I think the European banks are actually taking bold decisions to move rather quickly to get into a capital position that should make all of us feel pretty good about the stability of banking across Europe.
And we've seen ever more sophisticated and ever more onerous stress tests done. You can all have our view on them, but they have been much more robust than in the past. And the best protection for the banking system is a strong economy. So if we're successful in what this conference is about, prosperity across Europe, both in the EU 27 and in the UK, it effectively helps banks build capital and avoid losses. So that's what we should aspire to.
Well, Douglas, with that, I think it's a great positive note to end on. So I'd like to thank Jess and Douglas for taking the time, and thank you for your questions.
Good.